Good evening, everyone. This is Ashish Somaya. I'm CEO of White Oak Capital. It's my pleasure to welcome all of you this evening to the fourth edition of the White Oak Quarterly Connect. The Quarterly Connect, as some of you might be aware, and some of you who have got associated with White Oak only in the recent past may not be very familiar with. The White Oak Quarterly Connect is our quarterly initiative to update all our investors as well as our advisors and channel partners about the portfolios, about our views, our stance on any significant events, and also at the same time try and share our thoughts about some of the interesting investment opportunities in the landscape. So as far as today's agenda is concerned, you will see a presentation by my colleague and our founder, Prashant Khemka, followed by Ramesh Mantri. We also have lined up an interesting session with our financial services team, research team on fintech investment opportunities, which I think is an area of significant interest at this point in time. And after these two sessions, we'll be most happy to take questions and answers. So I'd like to thank all of you for taking the effort to join us consistently quarter after quarter. With that background, thank you once again. I would now like to hand over to my colleague, Prashant Khemka, to take the proceedings forward from here on.
Thank you, Ashish. Thank you, Ashish. And thank you everyone for joining us this evening for the Quarterly Connect session. I'm going to keep my comments brief as we want to make sure that we leave ample time for Q&A towards the tail end. Just a quick update. The team has, over the last 4.5 years, delivered solid results, strong results, as many of you are, if not all of you are aware, as a consequence of which you have reposed your confidence, interest in the team. That's helped us now grow to a AUM asset base of 42,000 crores, of which very glad to say that the domestic AUM has now grown to 10,000 crores. First time crossed the 10,000 crore figure. We can move on to the next slide. So what's helped achieve the performance over the last few years remains what I've always mentioned, and won't go into too much depth, as for with most of you, I must have covered this already. It's been delivered on the back of our strong, focused investment culture, what we refer to as performance first culture, meaning that the sole driver for all of us on the team is to strive to achieve the highest return for our client portfolios compared to anyone else in the peer group. And it's founded upon these 4 pillars: team, philosophy, process, and portfolio construction, which I'm sure we've discussed earlier. I would not go into the details of each one of this, except for just highlight that the team, since we last spoke, has been further strengthened. We continue to meet with very strong candidates. It's an ongoing process. And when we do find someone whom we believe would be a great addition to the team, we bring them on board. So it's extremely well-resourced team. It was an extremely well-resourced team to begin with, and even better resourced now with additions that we made in the recent months. Go to the next slide, please, now, and move to the macro backdrop for India. Before going on any macro discussion, which would be part of a lot of our Q&A today as well, I want to remind again that the most compelling reason to invest, which make Indian market far more exciting, is the strong alpha generation opportunity, the inefficiency of the market compared to other markets. In general, emerging markets tend to be more inefficient than developed markets. For example, in the US, as this slide shows, after fees, the average manager underperforms by a couple of percentage points or so. Whereas in India, at least this is as of pre-COVID published study in Wall Street Journal, shows that India offers the opportunity, at least over the prior 10 years, the average manager in India post fees still generated 2 to 3 percentage points of net alpha. So that inefficiency in the market provides the opportunity for extra returns, which is an important element of the total return. I think the market return should be expected to be in the similar range around the world, 5 to 6%, maybe the lower end of that range. For developed markets like US, higher end of the range for emerging markets like India, which one can argue is a small increment for the risk associated. So really the extraordinary juice lies in the alpha opportunity, the opportunity for outperformance, which our team has captured very well. We go to the next slide now and talk more about just what's happening. The longer term backdrop, as you know, would have heard us say before, that equity markets around the world tend to, and the empirical evidence supports it, that they tend to deliver returns in line with nominal GDP growth of the economy. So if you look at the US, Europe, and so on, over many decades, long periods, their returns are similar to nominal GDP growth rate plus a small fraction for the dividend yield. And in India also, it's been like that. And there's logical underpinning to it, which I'm sure we have discussed before, otherwise happy to answer in Q&A. The growth over the last 25, 30 years has been 11 to 12% in nominal GDP growth rate on the back of similar corporate earnings growth. Then the return from the market has also been in the same 11 to 12% zone. We go to next slide. Recently, the corporate earnings growth has picked up after a long period of lull. As you saw in the slide we just shared in the previous to this one, and as you can see in the lower left-hand side slide, last many years have been fairly mediocre earnings growth. From FY11 to FY20, we've not had a single double-digit growth. But FY21 was, after FY11, the first year of mid-teens growth. And that earnings growth is expected to accelerate further this year. Remains to be seen whether we get the projected 30%. Quite likely that 30% projection would need to be scaled down by the consensus, but still believe that 20-odd% earnings growth year over year is deliverable on the back of several factors, including some of the ones that are listed here. There has been market share consolidation over the last 18 months in favor of larger players in every industry, which tend to be, obviously, when I say larger, it does not mean the largest Nifty 50 players or anything. It's just that in every industry, the mom and pops and the unorganized sector has struggled more over the last 18 months due to supply chain disruptions. And as a result, the organized players, which is what listed companies tend to be for most part, they have gained market share. As we'll share some examples on the next slide that would further elaborate on this point. Secondly, just as you had supply chain disruptions in India, you had supply chain disruptions globally as well. As many of you on the call today, you run your own businesses and otherwise, have interactions with what's going on around the world in terms of import-export. Because of the supply chain disruptions, raw material prices and raw material availability has been a key shortage area. And there too, recognizing the risk, or I shouldn't say recognizing, the risk of being overly dependent on one country in the supply chain has further come to the forefront, and people, companies, corporates around the world, the leading corporates around the world, they want to further accelerate the diversification of supply chain from what has been overly dependent on China. Now, this is not something new. It has been going on for many years, but this trend picked up pace after Donald Trump, highlighted not just highlighted the risks, but introduced several tariff barriers and really escalated the pitch against China and asked corporates in America to find alternative sources. So it's been going on, and post the pandemic, that risk has further been escalated. And so a lot of corporates in India across manufacturing industries in particular have been benefiting from that diversification of supply chain away from China. There's also been certain sectoral specific developments that have helped this corporate earnings growth. First and foremost, I would highlight the technology, IT services segment. So overall tech spend around the world have accelerated after pandemic. I'm sure you all have heard in the media, and these CEOs of leading corporates, not only in India, but around the world, have noted that what would have been a gradual adoption of new age technologies over the next decade has been accelerated in a compressed time frame in 3 to 5 years. And Indian IT services companies are right at the heart of it in helping corporates globally, enterprises globally, to make this transition, and are benefiting from very strong growth of the kind that has not been seen at least in the last decade or even 2 decades. So their IT spending driven jump in the tech sector corporate earnings is very visible. And remember, IT services sector is the second largest sector in India, so it's not a small sector we're talking about. Besides this, obviously the smaller sectors like commodities, which have benefited due to the surge in commodity prices globally. While the sector is small, the rapid rise in the sharp surge in prices in global commodities has helped the corporate earnings to multiply in this sector. And also real estate, while again a small sector in the index, but there are several spillover effects into consumer durables and home appliances and other building materials and related industries, which are benefiting from the surge in real estate demand, particularly residential demand, which again is stronger than what it has been in at least a decade. So these are some of the factors that have supported the strong earnings growth and are expected to going forward as well. Just the first one, which I wanted to elaborate a little bit more, is the consolidation of market share in favor of the larger players. I hope you're able to see this on your screen, but even if you're not, I'll just read out. Let's take an example that we all can relate to: jewelry sector. So Titan reported just a week ago or so its numbers, and the 2-year CAGR, because year over year numbers are distorted. Last year was impacted by COVID. This year is impacted in different ways by COVID. But if you look at a 2-year number, compounded growth was in the high 20s, some 27, 28% compounded top line, if I'm not mistaken. Certainly, the jewelry industry has not grown at that pace. The industry might have barely grown low single-digit % or so. So what has helped Titan grow that much faster is the market share gain from mom and pops. A lot of the customers, clients, been hesitant to go into a small mom and pop store, and instead, during this pandemic time, find the large, well-organized stores of Titan, which are thousands of square feet, to be a more a safer and hygienic environment to do the shopping. Also, large players like Titan have leveraged the omni-channel mode of delivery and retailing far more effectively than small mom and pop players. So they've adopted the technology to showcase their jewelry while customers are at home. So instead of a customer having to come to a store and try on 50 or let's say a few dozen different types of designs, they can do the pre-selection online and then can just pick the right one from the store or can be delivered the right one to their home. So that's just one example, but across board in various industries, we've seen that the larger organized player have adapted themselves, evolved in a much better manner during this pandemic to adopt the technology, omni-channel delivery mechanisms, and gain market share from the unorganized sector. We go to the next slide, and then I would turn it over to Ramesh. I also want to highlight an important development, which we've been waiting for a long time to see as a real indicator of the government's reform agenda has been privatization. In the prior conversations also, I'm sure we have talked about it. And in our fact sheets, newsletters, which I hope you do take time to read, we have mentioned that what investors globally would be keenly watching for, and we are keenly watching for, is the progress that the government makes on privatization. And there it is very heartening to see, very encouraging to see the Air India privatization finally going through, or seems like has finally is going through, with at least the bidder Tatas having been selected in a very fair and transparent mechanism. Hopefully, this is first of many such to come. I think that's one of the biggest inefficiencies that has persisted in the Indian economy for much longer than it ought to. And the government has already selected a long list of PSUs for strategic divestments or outright privatizations, basically. We are very keen to see that following Air India, that process gains momentum. And if it does, that would be the biggest positive for the market and one of the biggest reform items that this government would be implementing. With that, I'm going to pause and look forward to answering some of your questions at the tail end and turn it over to Ramesh for going over the portfolio and performance over the last few months.
Yeah, thank you, Prashant, and good evening to all the participants joining this call. And I hope you're all well. First, talking about our performance, this year, our performance has kept up with the market. This has been, of course, a strong year for the markets. And one of the key characteristics of the market this year has been the strong outperformance of mid caps and small caps over large caps, which is something we had only seen earlier in 2017. So that's been the distinctive feature of the market. There are other features about the market that I would talk to you about in the attribution analysis for the first 9 months of this year. Now, this is our attribution analysis of our performance by industry sectors. While there's a lot of data on this slide, I'll focus on some of the key elements here. While any attribution analysis of a 9-month is a short period to draw any conclusive evidence of a manager's capability, but we thought we'll still highlight what happened in the last 9 months from our portfolio perspective. So as you can see, the portfolio returned 35% returns, the benchmark returned 332%, and a gross alpha of 3.2% was delivered over the 9 months. When you decompose this attribution, 5.3% returns came through stock selection effect, and -2 came through allocation effect. Allocation effect is the effect of either having higher or lower exposure to a particular industry sector during the period. While stock selection is about generating returns through stock picking in various industry sectors. As you can see, even over this period, more than 100% of our alpha has come through stock selection, which is a skill-based factor and should give you a lot of confidence in the investment team and our process. If you go more into what happened to the market during this period, if you think about the market this year has been a strongly pro-cyclical. Sectors have done exceedingly well this year. So the best performing sector in the market this year has been metals. Steel and aluminum are up 85%, when the market itself has delivered 32% return. Then the other best performing sectors are utilities, which largely comprises of PSUs, and then industrials. So these have been the best performing industry sectors. So all the best performing sectors tend to come from a pro-cyclical sectors of the market. If you think about the previous year, 2020, the first half, because of the first phase of the pandemic, the defensive sectors outperformed the market. And in the second half, the pro-cyclical sectors outperformed. And over a year, it was a lot more balanced market. But this year is a strongly pro-cyclical market. And what happened? So what are the weakest sectors this year? It's pharma, it's consumer staples, consumer discretionary, and financials. These are the weakest sectors in the market. When you think about how we structure our portfolio, and something that we have discussed a lot in our previous calls, is we always run balanced portfolios where we have a good balance between defensive sectors like consumer, pharma, technology in our portfolio, and then pro-cyclical sectors like financials, industrials, materials, real estate. This is one year where only the pro-cyclical elements part of the market have done exceedingly well. And because we run balanced portfolios, this has been a headwind to our portfolios. Yet, because the stock selection has been still strong over this period, we have been still able to prevent this headwind from creating a drag on our portfolio returns. And if you look at the composition of alpha, of course, technology has generated the highest alpha. Our biggest drag actually was at metals. And since we have earlier spoken, many times, metals is a global, macro sector. Large part of the fortunes of the metal sector gets determined by what the Chinese government does. So, and we don't have an additional edge on understanding what the Chinese government does. So that's actually been the sector that caused a lot of the drag in our allocation in our portfolio. Otherwise, our performance across sectors have been strong. The better way, I would say, is to look, and now we can talk about what stocks have, what are the top 10 contributors and detractors, which will again give a little more color on what happened in the first 9 months. Obviously, in a short period, whichever sector does well in the market, the biggest contributors will come from that sector. So in our portfolio, because technology has been the largest alpha generator, 5 out of the 10 names are from technology. But the interesting part is financials, which has been one of the weakest sectors. We in fact have top 2 contributors even coming from financials, which are Bajaj Finance, Finserv, and CAMS. That shows the ability of our stock picking. And then you have a number of stocks that come from various diverse sectors, including industrials, and including stocks from healthcare. Then again proves our stock picking ability. In terms of detractors, most of the detractors are coming from consumer, the top detractors, simply because consumer has been a weaker performing part of the market for short term. And of course, financials and pharma, again, these sectors have underperformed over the short period. And it's natural that detractors over a short period come from those sectors. However, when you look at this attribution analysis from a longer period, you get a very different picture, and actually you get a much truer sense of what our capabilities and our skills are. So if you look at first, we can even also go to the previous slide on this. First market cap attribution, over the last 2.5 years, which is slightly a better period to judge any manager's capability. As you can see, the alpha has been 38%, the bottom row, right corner, and the stock selection accounts for 46% of the returns, and allocation effect is -7. And we have delivered strong stock selection effect in each of the market cap bucket over the last 2.5 years of the Pioneer strategy. Moving on to the sector attribution. Again, over this period, out of the 38% returns, allocation effect accounts for less than 5% of the returns, and 36% of the returns have come through stock selection. Stock selection is positive in all industry sectors in the last 2.5 years. That showcases our ability of the investment team at White Oak to pick the best stocks across every industry sector. And finally, looking at the top 10 contributors and detractors over the last 2.5 years, you'll of course see a very different picture. The top 10 contributors come from a variety of industry sectors, from consumer, chemicals, pharma, financials, healthcare, industrials. That again showcases the diversity of our ability to pick stocks across industry sectors. So finally, looking at how our portfolio is positioned in the next slide. So as you can see, this slide shows the portfolio, different characteristics of our portfolio. We have 53 stocks, in a portfolio, and we have explained previously many times why we believe managing diversified portfolio is a better strategy to deliver alpha in the Indian market. In terms of our key characteristics of our portfolio, including our favorite metrics, the OpCo FinCo valuation metric, our portfolio is more attractive than the market, despite the fact that we don't own the companies with poor corporate governance, which are part of the index in our portfolio. In terms of market cap attribution, 57% of the portfolio is in large cap, 42% in small cap. So we continue to invest in the best ideas in large caps, mid caps, and small caps as a flexi cap strategy. And finally, looking at industry sectors, as you can see, we are invested in broadly all major industry sectors in the market. Energy and utilities, it's not that top down we are negative about energy and utilities. It's just that, these sectors have, large number of PSU companies, and we don't have an edge to generate alpha in PSU companies. And PSU companies, and yesterday's experience shows that they may not all the time be, managed for the benefit of minority shareholders, right? The alignment of management is not so clear. So in that context, I will stop here in the presentation and hand it over to the team to talk about FinTech.
Hi, good evening everyone. I am Parag Jariwala. I am joined by my colleague Akshay Jogani. We cover financial services and the fintech space. Over the next 20-25 minutes, we intend to illustrate how we think about fintech industry, its evolution, and how we evaluate fintech companies. On the next slide, but before we go into the discussion about the fintech industry, it is important to highlight why discussion on fintech industry is so important. As we can see here, 23 out of top 100 unicorns globally are fintechs. These 23 companies' cumulative valuation is around $400 billion. Compared to this, JP Morgan is the largest bank globally by market cap, and it has a market capitalization of only $500 billion. The largest fintech, PayPal, has already reached more than 50% of JP Morgan's market cap. In India also, fintech unicorns are valued at $60 billion, which is more than the market cap of largest bank in India, State Bank of India. Note that SBI accounts for 22% of Indian banking system. Financial services account for more than 30% weight in BSE 500 as well as in our portfolio. Fintech companies, if successful in their businesses, can take away not only the market share as well as profit share from the traditional players. In the next slide, if you look at the chart, it shows that how large the India opportunity can be. Of the 1.4 billion people in India, almost half have 4G connection. It means on an average, 2 individuals in a household have 4G connection. Half of the people who have 4G connection pay digitally, and 1/3 of digital payment users do financial transactions online. Despite this, if you look at some of the financial metrics on the right-hand side, we still have less than 100 million MF portfolios, less than 26 million NSE active Demat account, less than 60 million credit cards, less than 50 million retail health insurance, and large unmet credit demand. I would like to give you one interesting example as 2020 World Cup is going on. The number of people with active Hotstar subscription is almost equal to number of people who have purchased retail health insurance in India. And we think that's the opportunity. On the next slide, as we already said that large unmet credit and insurance demand exists in India for a long time now. It is difficult and costly to bridge this gap through a traditional way of doing the business. In addition, it will take decades for financial products to reach deep rural areas. But multiple things have changed on the supply side, which will help bridging the demand-supply gap. Firstly, as we have highlighted in prior slides, more than half of the population has internet access, and amount of data usage has grown through the roof in last 3-4 years. This internet access has enabled people to get more financially aware, share knowledge through YouTube, WhatsApp, and other modes of digital communication. As you can see in this slide here, most importantly, public digital infrastructure, Jan Dhan, Aadhaar, UPI, has played a pivotal role in simplifying access to digital financial services. In a way, internet plus digital infra has enabled companies to put whole gamut of financial services in an entry-level smartphone. On the next slide, because of the high digital penetration and supply side support by way of digital infrastructure, fintechs have grown at a rapid pace across the consumer financial journey, namely payments, lending, insurance, and savings. Across these subcategories, we have seen tremendous innovation, both in manufacturing as well as distribution. Take, for example, payments. We have government-led innovation in UPI, private sector-led innovation in cards, QR code, POS machine, payment gateways. Similarly, in lending, which is the largest profit pool in financial services, we have seen more than 1,000 fintechs trying to disturb various categories, building ability to distribute lending products to more people at a lower cost. In insurance and saving also, we have many companies offering online insurance, saving products like mutual fund equity with the least hassle. These companies, which act as an agent or a broker, offers wide variety of choice to the customer with good experience in buying online products. Now coming to next slide, as you can see, fintechs have grown at a rapid pace and the growth has only accelerated post-COVID. From minuscule digital payments, we have now $800 billion of UPI transaction. More than 75% of the new accounts opened digitally on discount broking app. Plus, we have increasing number of mutual fund inflows coming through our digital channels. This shift is led by specific value proposition that fintechs are offering, namely material improvement in experience, accessibility, simplicity, and lower cost. Now take example of a typical mutual fund buying process. A decade ago, most of the mutual fund buying journey was largely driven by agent coming to your house, filling up the form, investor giving them a check, and then agent will go to AMC or RTA office to deposit the form. Post that, investor would get allocation as the check clears in 2-3 days time. Now fast forward this to today. What you have to do is install an application, do 1-minute KYC, transfer funds through UPI, and in one click, your mutual fund buying process is over. Also think about opening a bank account. Even a decade ago, you have to go and visit a bank branch, share few documents. I still remember you have to carry 2 passport size photographs and bank would do the entire processing and your account will be get activated in probably 3-4 days time. Now fast forward it today, you can open a functionally operating bank account in a less than 10 minutes. All you need is a smartphone with camera and your Aadhaar card. These improvements are tremendous. Now, coming to next slide, if you see how fintechs have evolved in India, if you take few steps back and map India's fintech evolution over a time, you see that first 15 years of this millennium was a lot about payments. Interestingly, UPI came much after that. If you look at Paytm, Buildex, Pine Labs are all payment companies that were founded in this period. Of course, there were some non-payment companies like Zerodha, Policybazaar also got founded as they saw a large internet opportunity. In the next phase, we have seen e-commerce getting a lot of fundings. We had GST, we had Demon coming in, and we also had a cheap UPI. E-commerce funding and formalization of MSME due to GST opened up MSME financing market that was fairly untouched by the lending institution. This period marked founding of a large number of new age financiers that would lend to newly formalized economy. This led to market expansion and growth in profit pools. Post 2018-19, as payment companies have already created a massive base of digital transactors, we now see many companies that are offering some value-added proposition. Like, if you are on Paytm, now Paytm can offer you credit, even saving products like insurance, mutual fund. Their strong financial infrastructure in enabling quick credit, even to the bottom of the pyramid, is now possible. Now, another interesting aspect, if you see, there has been an evolution horizontally as well as vertically. Now, companies like Paytm, which were originally a payment companies, have broadened their canvas by offering horizontal services across the financial ecosystem. In some way, they are like financial supermarkets. On the other hand, there are companies which have stayed focused on their own way of doing business. Somebody like Policybazaar, who are offering a saving products. Now, coming to next slide, it brings us to monetization model in the fintech businesses. There are broadly three categories in which the fintechs fall. First is fee or flow model. These are the companies which charge commission on the stock of your money or on the flow. Somebody like Policybazaar that takes commission on the premium it generates. There are companies which gives you loans which charge underwriting margin or net interest margin. They take a percentage interest rate on the loans disbursed to you. And the third categories are SaaS and the PaaS companies, which charges fees for the software they provide. Now note that there are no company which is only one or two of this. There are a lot of companies which provide combination of all these services. Something like Turtle Meet which makes revenue from its software offering and from commission on the business sourced by these partner agents. Now, I would like to hand over a call to Akshay, who will talk about how do we evaluate fintech companies.
Sure. Thank you, Parag. Hello, everyone. Time and again, we get asked, how do we think about evaluating fintech companies that do not report accounting profits or have positive cash flows? The answer to this question is that the framework with which we view these businesses stays the same, but the tools and the lens that we use to evaluate them, they evolve. When we talk about superior returns on incremental capital, in this case, we lay focus more on contribution level, unit economics, and incremental return on capital. While companies don't report positive return on capital, a lot of the capital employed is actually spent on building categories and creating consumer behavior or changing consumer behavior. Then we look for large scalable opportunity, which my colleague Parag talked about, and then strong execution, right? Here, again, the lens evolves to looking for how company acquires a customer, how is the cost for acquiring a customer evolving. Even more important, how do they work on engagement models and how do they make sure that the customer continues to stay on the platform, repeat, and use the platform for multiple use cases. And then as a result, how do they control churn and how do they make sure that the customer doesn't drop off from the platform? Wherever available, you also look for analysis of cohorts to understand the evolution of a customer from coming on the platform to over time getting more and more revenue generating and profit generating for the company. Over a longer period, we think strong unit economics, high repeat usage, and low customer churn will deliver cash flows and profitability. To give an example of what I just talked about from a framework point of view, let's look at this hypothetical fintech platform that sells health insurance online. The way this business works is that the company spends a bunch of money on getting customers on the platform and then sells them health insurance. And for doing this, they get a commission from the insurance company. And then when the cycle changes, and in the next year, when the customer comes to renew their policy, it is at that time they do not have to spend on getting the customer on the platform. And in this case, then they make a much higher margin. Now, if you look at the P&L from an accounting point of view, what you see is that in the first year, company loses a lot of money. It loses more money than it makes in revenue, right? And if you see that, it seems like this is a terrible business to be in. But if you fast forward to year 3, it looks like a tremendous business to be in. In reality, though, what is changing is that the customer acquisition cost is getting upfronted. And as a result, a single year P&L looks distorted. Secondly, as these companies grow really fast, all the extra money that they generate gets spent in acquiring customers because these customers become profitable. As a result, the combined economics of first year new customer and a third-year-old customer still looks like not so great economics, right? More importantly, the business is dependent on metrics such as repeat rate, churn, and cross-sell revenue. And as a result, they become the important metrics that we track. Now, key to see value being created in these businesses is to sort of be able to peel the onion and distill the cohort economics over a life as against any particular given period. That brings us to payments, which is the first of the large piece of the fintech landscape. India is very different in terms of how payments evolved in India. Across the world, payments companies make money and good money. But in India, despite the tremendous growth in digital payments, the profit pools have not expanded. And in fact, some of them have also contracted. And the reason is UPI, which is completely non-monetizable, either online or offline. Right? We think what will happen over the next few years, and it has already started, is that payments will continue to stay there in terms of the profit pools, but grow in terms of the volumes. And companies in this business will use payments as a customer or a merchant acquisition tool instead of a profit generating business. And then using customer and acquiring these customers and acquiring these merchants, what they will do is, and they've already started doing, is give credit to the merchant, give buy now, pay later solutions to the merchant, which the merchant can offer to the consumers, and even provide a software stack to run the business in an efficient format. The discussion on credit is an interesting one, and it gets us to to credit and digital credit. Digital credit in general is the largest opportunity in the country, and it is so for digital lenders too. So when we talk about digital lending, the first question that generally comes is, what is digital lending exactly? And if you had to put it very simply, it is essentially a technology and an operation stack combined that does following 3 things at scale. First, acquire customers digitally. Second, drive repeat usage. And third, automate underwriting customers using technology and analytics, right? And then the obvious question is, why are these 3 relevant? Because combination of these 3 sets off a positive feedback loop, which helps fintech scale at a rapid pace. The first point is acquiring customers, right? And so being present at point of sale or when a customer needs credit helps these companies acquire customer at low cost. Then being able to underwrite them very quickly with technology and analytics and providing them with credit as required helps convert these customers from the top of the funnel to revenue generating. And then great experience across the process from acquiring customer to underwriting, disbursement, and repayment, plus being again present at the point of sale drives loyalty and repeat usage. And the repeat usage is what drives scaling at a really, really rapid pace. And this leads the companies to market dominance and profitability. So how do we see a disruption in this space, right? if you take a few steps back and think about how are the digital lenders different from traditional lenders, there are three things. There are lots of factors, but the three things that really come to our mind, which are large, are A, underwriting. This is where fintechs are ahead in certain cases due to their ability to use technology and analytics to do automated rule-based underwriting. Second, distribution. Again, fintechs have been really brisk in building distribution online and offline. And third, cost of funds. Here, incumbents have strong cost of fund advantages and hence ability to give low interest rates because of their legacy, history, and strong balance sheets. And so it is evident that fintechs have decided to compete on distribution, which is where they have the forte, and on the speed of underwriting, which is what technology has helped them do, right? And doing this is the clear competitive advantage that fintechs have versus what incumbents have is a clear competitive advantage on low cost of funding. And that differential is what has led to choosing of which sectors these companies operate in and where disruption is most prominent. If you look at housing, for example, right, and on this graph is an interesting graph. On the x-axis, what you see is sensitivity to availability and turnaround time. On the y-axis, what you see is sensitivity to interest rates. If you look at home loan, generally everyone is very sensitive to what interest rates that they get the home loan at, right? And as a result, the company that can give the lowest rate is the company that gets the business. If you go to the other extreme and look at consumer durables loans, here sensitivity, especially to the subprime set of people, right? Here sensitivity is to availability as such, in the sense that the fact that I can get a loan itself to buy a cell phone, which I don't have enough money for, in itself is what drives the business. The rate of interest is not as relevant given the size of the ticket size and the amount of interest absolutely that has to be paid. And right, so if in that case, who we think or what will it take really to win? We think at the end of the day, lending business is going to be about ability to understand and price the risk correctly. And then on top of it, ability to acquire customers and get them to repeat, give them a great experience, right? If they do this, if companies are able to actually deliver on these three things, what will happen is that they will scale quickly, and as a result, and they will scale very profitably. And if they do that, then because of the growth in scale, they will be able to also work towards cost of fund advantages, and hence go into competing in areas where incumbents are far stronger. That brings us to savings and investments, which is the other area where we see very clear impact of fintechs. More than 3/4 of all the accounts on NSE active accounts opened were all opened at discount broking companies which have completely digital processes, right? Which tells that the impact of digital is maximum here, and every one of us on this platform has felt it, right? We think companies have now reached the scale. A few of them have built meaningful brands and are also getting into manufacturing savings and investment products, right? Over time, as these companies scale, we think what will require to win, especially in manufacturing of savings investment products, is the ability to deliver performance and product innovation. On the distribution front, we think it's fairly clear the great experience, low cost is what has led winners, and I mean some of it is now fairly clear. That brings us to the last and the most peculiar piece of the fintech space. This is insurance, incredibly complex products, deep dependence on distribution channels, right? This is fintechs in general, interestingly figured out that the bottleneck in the insurance value chain is really not manufacturing, but distribution. And almost every company in fintech has put effort and built a business to disrupt or disintermediate distribution, right? Even the latest unicorn in India, right? ACO, is actually a manufacturing, essentially an insurance manufacturer, but the thesis behind the business is to go direct to consumer and essentially disintermediate the distribution completely, which again kind of says that distribution is where all the innovation has happened, and looks like that's where all the value is going to get created. Here, in order to win, we think what is going to be the most critical, and it is what all the companies are focusing on, is just controlling customer journeys, giving them a delightful experience when they're buying insurance and when they are going through the claims process. And then when companies do that, that will drive down low customer acquisition costs. To summarize what we spoke about in the last 20 minutes or so, we think fintechs are going to continue and accelerate the disruption of incumbents. Increasingly, fintechs are becoming larger and larger part of the market, but in the next 5 to 10 years, they will become very, very meaningful. And if you see, Parag talked about 30% plus of the market and of our portfolios is financial services businesses, right? Which means that how these fintechs evolve has clear implication on how the incumbents perform and do well or not, right? We also think incumbents not embracing the change have already started losing profit share. And very, very clear example of this is retail broking industry, where discount brokers have completely, in a very, very short span, taken the market, right? That said, basic principles on how we think about valuing these businesses stay the same. However, what is really going to matter is being able to understand long-term cash flow generation and sources of those long-term cash flow generation potential, right? And so what we are focused on as a team is investing in fintech companies that are dominant, that have solid positive economics, and are present in large markets and are run by teams we think are credible and have ability to actually deliver. With that, that brings us to the end of our presentation. I'd like to hand over the call to Vivek for the next session. Thank you.
Thank you, Akshay. Thank you, Parag, for a very interesting session. And I can see there are a lot of questions on the fintech space that you spoke about. Hi, Prashant, and hi, Ramesh. Maybe we'll set off the Q&A with what is increasingly becoming the most common question being asked in all our interactions with clients and advisors. And is, given that the markets are at 18,000, we've been seeing new highs repeatedly. What should be the strategy from a deployment perspective? People have cash, to deploy that. And what are your thoughts of the market levels, and how should one approach investing now? Maybe Prashant, you could address this.
In our view, and thanks, Vivek, for the question, and to the client who's asked the question. But as most of you know our view on this, the view always has remained consistent, whether the market or Nifty or Sensex was at 800 or 8,000 or 10,000 or 15 or 18, and unlikely to change regardless of whether the market goes to, which eventually it would, to 50,000 Nifty or whatever, whenever that is. It is, the markets are more or less destined to go higher over time. It's important to remember that markets are not like a casino going, one has to lose for other to win. Oftentimes how it is painted, colloquially speaking. Markets are a reflection of or a certain multiple, when they're reflection, meaning not necessarily one-to-one, but they are certain multiple of underlying corporate profits, cash flows. Over time, corporate profits grow. Sometimes they grow faster, sometimes they grow slower, maybe take a pause once in a while, but measured over multiple years, corporate profits grow. They tend to grow in line with nominal GDP of a country or the economy. That's what I was sharing earlier. So if you look at the US, Europe, other places, markets have gone up over time, more or less at the pace of nominal economy. And when I say over time, I'm talking about measured in decades, not necessarily months or quarters or years. Same way in India, if you look at over the last 30 years, 20 years, markets have gone higher, more or less at the pace of nominal GDP. So if real GDP in India is going to grow at, call it 5 to 7% over the next many years, and GDP deflator, which is akin to inflation, is going to be another 4-5%. Call it on the whole 10, 11, 10, 12% is what the nominal GDP is going to grow. So very likely the market would grow 10 to 12%, would climb 10 to 12% over time. It doesn't happen like fixed deposit, but that is why you don't make money in fixed deposit. In fact, as many of you know, what we've spoken about, and Dipojal, if you can bring up the slide, fixed deposit is guaranteed returns, but it is guaranteed real loss. Markets are uncertain compounding gains. Very high likelihood that compounding at 10. So this is a good slide here at the top, as you see the title, fixed deposit versus equities. Over the last 36 years, I've chosen 36 years because 36 years ago is when I started investing in equity markets for family. We didn't have 1 crore, but just I'm using a crore so that the audience can relate to better. But 1 crore in 1985 invested in fixed deposit after tax would have been only 8 crores today. Inflation itself would have been 13 crores. So fixed deposit has been a guarantee to make you poorer in real terms. And that is not just in India. It's true everywhere in the world. Almost, it's like an unwritten law of finance that if you invest in something that is guaranteed, risk-free, then after tax, you cannot keep up with inflation. And it's only fair, one can argue, it's only reasonable, because otherwise the Rockefellers and all would still be the richest people of all times, and would be very difficult for anyone else to catch up. So remember, fixed income is guaranteed real loss, and equities, if you see over the last 36 years, 1 crore just investing in ETF or a Sensex like basket of stocks, 1 crore would have gone to 135 crores, compounding at about the nominal GDP plus dividend yield at a pace of about 15%. And if you can add alpha, India being such an alpha rich market, if you can add alpha yourself or with some manager, then depending on how much alpha you can add, the compounding makes sure that the impact on wealth creation is that much stronger. And just a 10, I say just a 10%, 10% is not easy. It's a very difficult amount of alpha to add, but many people have added, not just ourselves over the last few years. Those who've added 10% alpha on top of 15% for a return of 25%, 1 crore has gone to 2,800 crores. So the reason also to cite this 10% alpha is to emphasize that each incremental percentage point has a disproportionate impact on wealth creation. Normally, without showing the graph and without the calculation, if I ask someone that if over the last 36 years, growing at 15% return, if your money would have compounded to 135 crores, how much would it be growing at 25%? Many a times I've got answered 250 crores, because the argument is if 15% is 135, then 30% would make it 270. Since 25 is less than 30%, maybe it's 250. But no, the answer at 25% would be 2,800 crores. So the opportunity cost of trying to time the market is humongous, is huge. Okay, depending on which track you are on, whether you're on equities or well-managed portfolio, or regardless of, even if you're invested in gold, which 1 crore would have been 24 crores, I would have said timing the market would have been, the opportunity cost would have been very, very serious. So that is one, that the cost is huge. Second, what is the likelihood of success? In my view, it's zero. It is impossible to try to time the market. It is, your odds are just as good and no better and no worse as they are in predicting a coin flip. So you do lose out, because if you don't invest in the market, you're in fixed income. So the opportunity cost is high. But keeping that aside, the likelihood of being right is just as good as in coin flip. And it's not just you, it's for me, it's for Ramesh, it's for everyone here, and it's even for Warren Buffett or Peter Lynch or anyone in the world. It's like, right now the World Cup cricket is going on. right? So Kohli is a fantastic captain. Dhoni earlier was fantastic captain. We love them. We expect them to play great cricket, but we can't expect them to win the toss at the start of the game. We can repent that India lost the match against Pakistan because Pakistan won the toss and they put us to bat. Might be that outcome would have been different. India had won the toss. But all that said, you cannot expect the best fund manager to predict the market any better than a coin flip, just as you can't expect the top-notch cricketer to predict the coin toss at the start of the game any better than the lay person. So trying to time the market, we are convinced, is destined, with some exceptions, maybe destined to be a losing game, losing proposition. Whereas stock picking is, I won't say destined, but stock picking has the potential to be a big winning game. I can go on this. I get this question on almost the highest number of questions pertain to this aspect, which is one way or the other related to timing the market. Oftentimes it sounds repetitive. I try to be creative and give different examples, but ultimately the gist is the same and there's no other way of putting it across. Vivek, back to you.
Thank you so much, Prashant, for that. And I think as a segue to that, we have a question on a particular sector, and I know stock selection has contributed to majority of the outperformance and alpha. And Ramesh, this is on the IT sector where we have some of our largest contributors over the last 4 years since we started. The question is, why don't IT companies get the same kind of valuation as some of the consumer companies like Nestle, HUL, and so on and so forth?
Yeah, that's a great question. And if you look at, I think the most important driver of valuation, longer term valuation, is the sustainability of the competitive advantage. And when you think of a company like Nestle or Unilever, one, they operate within the Indian market. Their competition is confined to the brands that they compete, because a Chinese or a European or an East European company or an American company can't compete in the consumer categories with the Indian company. So typical Nestle or Unilever, some of the large consumer companies in India, most of the leading brands actually have 50% market share. And often the number one brand is multiples the size of number two brands. And consumer categories, the brand shares tend to be very consistent over time. So that moat is an extraordinary moat in consumer business of brands. And of course, in a country like India, even distribution in FMCG businesses is a moat. However, IT sectors, despite the fact that it is a global industry, it is, spending is $1.5 billion. And if you add ER&D, it's close to $2.5 billion, the whole $1 trillion, the potential. Yet, there are thousands of IT services companies that compete. Ultimately, an Indian IT services company competes with an American company, with a European company, with a Latin American company, and with other companies from emerging markets. So technology, and secondly, technology also constantly changes, and there's a higher mortality rate in technology. So because of the fact that you can have a brand like Maggi go through challenges and yet come out very few years. But that doesn't happen to a technology services company. If they really deliver bad experience to the customer, it's not easy to come back. So the sustainability of the moat is much stronger in FMCG companies versus IT services company. At the same time, the growth in IT services companies has been stronger. So what is today the disadvantage on the competitive moat is the opportunity for the IT services companies, that even today, you have 12% market share in global IT spending for Indian companies. And within that, even the largest technology services company out of India, which is TCS, has a less than 2.5% market share. So if you execute well, you have a long runway of growth, but it is focused on execution. If you go back 4 years ago, the difference in valuation between consumer and technologies was very stark. The multiples even on free cash flow were 4 to 5 times. They now, I would say, are more closer to 1.5 to, okay, some of the mid caps is 1.5 times, and on the large caps is about 2 times. So there has been a convergence in the last 4 years between consumer and technology, but there are good reasons to believe that overall FMCG companies can trade at higher multiples over time. Yet, exceptionally well executing mid technology services company, and if they deliver execution consistently at high growth rates, they have no reason they cannot trade at consumer multiples. Yeah.
Sure, Ramesh. Thanks for that. And maybe just jumping to the sector which Parag covers, and there is some questions on fintech. And interestingly, the first question that there is Parag, you mentioned currently there's 30% plus weight in financials, and obviously a large part of that is in some of the private sector banks that the portfolio. The question is, what do you think could be the potential impact, if any, that fintech companies would have on banks that we hold in the portfolio?
Sure, Vivek. Interesting. So see, firstly, world over, there is a debate that who will win between traditional banks versus fintechs. However, if you look at in India, especially the private banks, I will not call them a traditional banks. There is a strong fintech within these private banks which is well equipped to fight with the fintechs. There is absolutely nothing. If you look at if you are a customer of any top-notch private banks, there is absolutely nothing which they cannot do, which you can do it on probably any other fintech apps like Paytm or BigQuick. Because if you look at iMobile app or HDFC's PayZapp app, they are very fine and been developed, nurtured, and progressed over a period of time. However, we need to remember that to stay ahead or to fight the competition, they need to continuously innovate and keep themselves up to date. They will have to keep entering into a profitable partnership with niche fintechs to expand the addressable markets. And the best example, many of us are aware, ICICI Bank partnership with Amazon for their credit card, and it has gained a phenomenal response. And by doing so, they will not only able to grow the markets, and also they will able to grow it at a less cost. So, what I can say is that we are closely watching the threat of fintechs on our coverage universe, their response and step taken by them to win over the current situation. And at present, we are fairly comfortable with their fintech offerings, with their partnership, and in the line of business they are into, as Akshay touched upon, that the interest sensitive markets, which is home loan, auto loans, etc., have been less impact of the fintechs. And most of the private sector banks which are in our coverage universe are mainly cater to those retail segments. Plus, they are very well equipped. Their fintechs capabilities are up to date. Their partnerships are quite encouraging. So we are fairly comfortable at this point in time. Vivek?
Yeah, great. Thanks, Parag. And maybe again, switching to another sector, and which has been in the news recently, and Prashant obviously touched upon it, the Air India privatization. And Prashant, you mentioned that this is an important milestone. What do you think could be? Do you see large-scale value creation in this sector finally, or your thoughts on the entire Air India privatization?
So Air India privatization is a big positive for the nation. It would create a lot of value for the citizens by not destroying the value that it has been destroying for the last, 60, 70 years, following the nationalization of Air India. It is immaterial in some ways to the importance of the significance of the decision. It is immaterial in some ways whether or not the sector becomes profitable. It's not that the sector is not profitable because of Air India. The various other issues that may be worldwide, most places, airline sector is prone to hyper competition and low profitability. Even countries like where there is no developed countries, where there is no national carrier. So that is a different topic. We don't have any investments in airline companies as of now. We'll continue to be open-minded, but the Air India privatization in and itself does not lend greater odds of profitability to the sector. If anything, a better run, well-run, privately operated player adds one more serious competitor to the space, formidable competitor to the space, and remains to be seen how the sector profitability evolves. But most importantly, it's very profitable for the people of the citizens of the country, as those resources can be better utilized elsewhere. And that is the biggest upside, in privatizing other government-owned companies as well.
Sure. Thanks, Prashant. And moving from airlines to more new age and tech companies and new listings. Again, one of the things that we hear often from clients and advisors is what is our thinking of some of the new listings which are either coming or going on, just have been recently listed, like the likes of Nykaa, Zomato, Policybazaar, so on and so forth. What are your thoughts? And maybe Ramesh, you can answer, and Prashant can also add to it along these lines. Of these new age companies and tech internet companies that's coming up for listing now.
I would let Ramesh actually should address this question, but I would just caveat, unfortunately, in such a format, it's not prudent to talk about specific companies, but we can talk more generally about this space. Ramesh?
Yeah, sure. So see, what the new age companies are trying to do, see, they are investing on three fronts. One is building the technology stack, acquiring customers, and delivering great customer experiences. And while a traditional, let's say, manufacturing company invests in a plant, their investments are focused on technology, customer acquisition, and customer experience. Just because the acquisitions are not accounted for as fixed assets or capital assets does not mean they are rightful investments. So what the problem with traditional accounting is that a plant gets capitalized while investments in brand, in technology gets charged off to P&L. So from an accounting perspective, often these kind of quality investments often look as expenses. And that's why from a traditional accounting perspective, they look as losses. These companies start showing losses. While they may be acquiring customers who have very large, lifetime value over the cost of, acquisition of the customer. For example, the example Akshay showed for health insurance in FinTech, which had an LTV to CAC ratio of 4.4. That means for every rupee that you're investing, you're getting 4 rupees in returns over long term. That is a highly NPV accretive decision. And if you have that kind of business, that business should be aggressively investing in acquiring more customers. And of course, the landscape now with ubiquity of data, the payments problem solved with UPI, and now the logistic infrastructure coming with a variety of logistic companies. E-commerce is booming, and direct-to-consumer brands are emerging, and fintech is booming. So these are creating disruptive opportunities and business models, to create value to customers, sometimes solving very difficult problems. For example, in retailing in India, one of the difficult problems in tier 2 cities and 3 cities is just product availability. And I'm just the example of Nykaa, more than 60% of their sales come from tier 2, tier 3 cities because the beauty products are not available. Similar example is for Amazon. And for normal consumers in tier 1 cities, they solve the problem of product discovery and of course, offer slightly better prices and convenience. So the economic value these businesses are adding at a collective level is humongous, and they're changing the structure of industries. And we at White Oak, would look at this business from the same lens at which we look at every company, that we would like to invest in great companies at the right price. And the attributes of great companies are superior returns on incremental capital, long-term growth opportunity, strong execution and governance. As Parag and Akshay talked about, the tools and lenses to judge these attributes may be different in new age companies. But as long as you have companies which are industry leaders with positive economics, serving large and growing markets, and run by credible management teams. And they still have to be available at the right price, because at White Oak, we're clearly sensitive about prices we pay for businesses. So when all these attributes come together, we will evaluate every company on its merit. And we have invested in certain new age companies, recently, and even the few ones that traded in the public markets in before the recent year, we have been investors in them. So it'll be every company on its merit.
Just to add, see, this is for India, the first time that these companies are coming to the market, right? And all these questions are being raised. And as I was saying earlier on one of the TV channels earlier today, this phenomenon has played out in US nearly 25 years ago, mid-90s, late 90s and all. We all know the dot-com bubble. What was the dot-com bubble? Now we call them new age tech companies. They were called dot-coms then. Then you had a website. You had to type www.nykaa.com or policybazaar.com. Today we call them apps, because instead of websites, they're apps on the phone. But it's the same thing. Now in the 90s, the risk was a lot higher, because it was the first time. It was, to quote Star Trek, it was like going to a place where no human had gone before. But now, 25 years later, we have the history of how this industry has evolved all around the world. India is one of the last ones. If you look at US, in the mid-90s, the weight of these new age tech companies was 0. Today, it's probably north of 25%, with some of the largest companies all coming from more or less new age, which weren't new age have become new age now. China went through that journey 10, 12 years ago. Korea went through that journey 10 to 15 years ago. And most other markets have gone through that journey already. They've been to this body, if you will, in the Star Trek parlance. They've been to this place, and it is, yes, a different place. It has certain different characteristics, but yet huge value creation has been achieved. If you look at these markets, you all are very familiar with the US market. Most of you, I suppose, a lot of you have asked me over the time and asked our team how to participate in the wealth creation by the FANG stocks and the NASDAQ stocks and so on. What are these companies? These were, for most part, these are companies that at some point, in fact, majority of the FANG companies were loss-making when they came to the public market, when they did their IPO. Apple itself was a loss-making company when they did their IPO. You cannot write off these companies just because they are loss-making. You have to bake in quite likely, if India follows, which it would, the US or China, that these companies would end up making maybe 20% of the market cap of the country in the next 10 to 20 years. You can either wait and then invest once they've become the leader and still maybe on decent returns from the space. But a more rewarding strategy, I believe, is what we are adopting. I think it behooves, as I said, it is incumbent upon all investment teams to look for and evaluate the ideas on their merit. I'm not saying just because they're loss-making, you must invest in them. There were thousands of companies which seemed like could be winners in the late 90s and early 2000s, which are nowhere today to be found, like AOL, Yahoo, and all in the US market, and a lot of other names which nobody would be able to identify on this call. But at the same time, there are many, many others, hundreds, if not more, which have gone on to create tremendous value. And it is our job, it is our duty, it is our expertise to be able to find those opportunities, and nobody gets 100% right or anywhere near 100% right. But if, like in other sectors, other segments of the market, we believe we so far, whatever is the early or limited track record, it is very strong in this space. The team has identified some great opportunities in this space. Remember, there have been few names in this space that have been listed for long. And now it is obviously mushrooming because we've reached that critical threshold where a lot of companies are making the cut to come to the market. But the team has had extraordinary success thus far in generating alpha in this new age tech space. And if we can keep that up, I think it would be a big mistake to let go and not work on this segment of the market. There'll be very many exciting opportunities, and I, for one, am very excited. Then the team is very excited, and the team is very well equipped to identify and benefit from these opportunities down the line.
Thanks so much, Prashant, for that. I think we have time for a couple of more questions. Maybe I'll just ask a question to Parag and Ramesh. So the question is, clients who've invested with us have seen their portfolios, and they often ask is, what is your exit strategy? In the sense, they understand our philosophy of buying great business at attractive valuations. So do you have a target price in mind, a target holding period when you enter into a stock? And what are the factors determine when you want to exit or trim the stock? And Parag, maybe you could answer this for your sector, and then Ramesh could quickly answer before I ask the last question to Prashant after that.
Sure. I think we have highlighted a couple of times that, our thought process is, investing in a great business at an attractive valuation, right? So, while investing, we take into account a lot of this aspect into mind in terms of liquidity, in terms of potential return, in terms of, how things are unfolding. So as and when, the stock gives an adequate return in terms of our expectation about the businesses, obviously we have to keep evaluating that business at each stage, right? So, there are quarterly releases, there are certain, initiatives taken by the management and all. And whenever we think that, the potential return which we were expecting about stock is fully reached about, and then we decide to exit that stock. So it is always a combination of, where we find an alternate opportunity, what are the returns which we have made, what is the future outlook of that stock. And based on that, we decide to either trim or exit the position.
Ideally, when you invest in a stock, you'd like to own it forever. That is because you invest in that kind of great business management team and you invest at the right price. But over time, things change, and the best change is when the stock does exceedingly well and you achieve your price target, and you no longer have the kind of upside, your expected returns, and you relocate the capital to better opportunities. There are also times when we sell a stock simply because we have better opportunities for the same return, for higher return. For example, in the same sector, same risk, if you have one stock with 15% upside and the stock with 35% upside, it is better to sell the stock with 15% upside and relocate the capital to the one with 35% upside. The one time that we clearly sell out of our position is, we are very clear about this, is whenever there's a corporate governance event in our portfolio company. Touch wood, that hasn't happened yet, but that's something with a clear operating discipline we have. Corporate governance is a very key filter that we use to invest. If you look at our history, long-term history, our average holding period has been, slightly over 3 years. Within that, there'll be companies that, with Prashant's previous track record, we held that stocks for a decade also, because, those companies have been, done exceedingly well. And the others we sell out early because we achieve our price targets. And we've always been very clear that we are sensitive to valuation. We are not like buy and hold investors. We will invest in a great business at the right price.
So just adding here, we are not buy and hold for the sake of buy and hold. The goal for everyone on the team is clear: maximizing return in the portfolio. And I know there is a lot of these marketing gimmicks. I would say either I would call them marketing gimmicks or naive beliefs. Low churn for the sake of low churn is of no value to investors. Buy and hold for sake of buy and hold is no value. Concentrated portfolio, focused portfolio, all these are good. They sound well, but may or may not add any value, and in fact could be counterproductive. The game of investing is highly competitive in and of itself. And if you put on all these restrictions and handcuffs on yourself, so just like any game you play, if you put on restrictions and handcuffs, so even in football, which doesn't require use of hands, right? Even in football, if you play football with your hands handcuffed, you'll have a far more suboptimal game than if you have your hands free. And in investing, you must do what is sensible. We believe we do what is sensible to achieve maximum return. Think of it in terms of selling discipline. Think of it as your portfolio. Let's say you have 50 investments in it. Think of it as you've invested in 50 different businesses. You have a large group of friends and you're investing in their businesses. At the same time, all your friends are bidding a price. At any point, if you want to sell your investment, they're quoting a price. Now you have $100 and you're investing, and based on your cash flow investment and what is the expectation of cash flows from their business that you're invested in the various businesses, if somebody else is going to bid you such a high price that no longer from a particular investment can you expect to earn very high return, a certain, let's say 20% return, you can no longer earn, then it is better to give that business, the stake in that business, to whomsoever is bidding that high price, and use that money to add to one of the other businesses that you have invested in, where you're still getting more than 20% return based on the expected cash flows of those businesses. Or if there is any new business that comes up for investment, because you have limited amount of money, you don't want to leverage, and this new business opportunity that's come in is extraordinarily strong with say 25%, 30% expected return on your investment, then what would you as a sensible businessman do? You would, or investor do, you would exit something in the portfolio that is at that time the lowest return expected from your investment to redeploy that capital in that new opportunity. So that's how we think about it, rather than having this constraint on, oh, I would own for 10 years, or I would not have more than 10% churn and all. Those are unnecessary and suboptimal constraints to have. Having said all that, our average holding period over a long period of time has turned out to be 3 years. It's something that is an outcome. You shouldn't go in as a target. It's something that is an outcome.
Certainly, Prashant. And I think you kind of spoke about that, having a constant portfolio, diversified portfolio. And one of the things we get asked very often is that the current portfolio has 53 names. The question, and I know this is a question you've been addressing for the last many, many years. What are your thoughts, and why do you think having a great number of names actually helps in alpha generation?
Certainly, I actually firmly believe larger number of names generates higher return. It's not the diversification benefit. That is just that we have. That's the reason for having higher number of names. Diversification benefit is just a byproduct. It happens to be a desirable byproduct, but that's not the aim here. When I was at Goldman Sachs prior to White Oak, I used to have 75 to 100 names typically in the portfolio. And in the initial years, I used to have strong pushback from clients, consultants, and other experts that with so many names, how can you become like an index? How will you outperform? Over the 10-year period at Goldman, very consistently, it was pretty much the top performing fund, because if you do it properly and if you have the skill, if the team has the alpha generating capability, larger number of names allows you to generate higher alpha. Concentrated portfolio predisposes or is more susceptible to chance or luck and to extreme outcomes, possibly in either direction, driven by chance or luck more than skill, in my view. If you have skill, it is more difficult to, underperform vastly over any short time period. So you can also generate consistent alpha and generate higher alpha with larger number of names. And the key reason is, again, I've spoken about this to most of you and our team has spoken about this to a lot of you in one-on-one conversations. The key reason is, if you have, let's say, many of our peers manage 20,000 crores of AUM. If they have a 20 name portfolio, an artificial constraint or the handcuff, they have shackled themselves in handcuffs so that they'll only invest in 20 names. Let's add another constraint that it's equal weighted or something like that. So just to keep the math simple, if you're investing 5% of your portfolio in one name, it's a 20,000 crore portfolio, then the average investment would be 1,000 crores. If you're investing 1,000 crores, then you're typically looking at companies that are more than 15 to 20,000 crores in market cap, right? There are only about 200 companies or so in India, if I'm not mistaken, that is around this kind of market cap. So you'll be limiting yourself to a much smaller universe of companies, which more or less everyone else is also looking at, because they also have this similar handcuff. Global, there are a lot of global players who are not just Indian players, but a lot of global investors, foreign institutional investors. When I was running Goldman Sachs fund, that was the thing. I saw a lot of these peer group who had similar restrictions and would, for different reasons, they would only look at the top 100, 200 names. That leaves many hundreds of names outside of this top 200 names, which are not being properly researched. And there's some gem of opportunities in there. And if you look at the top 10 names, contributors and detractors, maybe Dipojal, we can pull that up if we have the time. But there are several names which none of these so-called focused funds that are very reputed out there can buy, because you can't buy 1,000 crores in a company whose market cap is 5,000 crores or 10,000 crores. But you can buy 100 crores, 200 crores, 300 crores in a company whose market cap is 5,000 crores. And if that triples or quadruples, as has happened, if you select and do the job well, then that generates huge alpha. And a collection of such names that you invest in 200, 300, 400, 500 crores, a collection of such names adds up to 10+% of the portfolio, and it's delivered very strong returns. So if you look at the top 10 contributors that over the last 4 years, the first strategy that team launched, in that included in there is Naveen Fluorine, which he started at about a 1% position when it was a 3,500 crore market cap or so. Ipca Labs, we held 1+% when it was a 6,000 crore company. Dixon, which is third from the bottom, we bought it when it was 3,500 crore company. Today it's closer to 30,000 crore company, right? So if we had this artificial constraint or handcuffs of buying only 20 names, we would have not invested in Dixon when it was 1/8 or thereabouts of the price that it is today, and would now be evaluating it for investment. So Vivek, I hope that answers the question.
Yes, it does, Prashant. And we're actually out of time. We've like 10 minutes over, and it's a Friday evening just before Diwali. So maybe, I'll take this opportunity to thank all of you for being on the panel. And of course, more importantly, thank all our clients who've joined us today and all the advisors joined us today. Wishing all of you a very happy Diwali and a prosperous New Year. And we look forward to having all of you join us again in the next edition in early part of 2022.
Likewise, also Vivek, I want to thank everyone and wish them all a very happy festive season, a happy Diwali on behalf of the team, and thank them. Take this opportunity to thank them all for investing with us or considering us for investment. Really appreciate it. Thank you all. Bye-bye.